Hello and welcome to this Friday's morning market briefing. We've got a lot to talk about, but firstly, private equity stakes unloaded at a discount as investors seek exits, as well as that Google now considers charging for AI-powered search in big change to business model. We've got lots to talk about in the charts. Also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, make sure you subscribe. The first article to talk about is, of course, on the topic of private equity. Now, institutional investors in the US are now selling more of their private equity holdings at a serious discount in order to reduce their own exposure to the illiquid asset class. The investors which lead in doing this action included pension funds and endowments, with big investors selling 99% of their private equity holdings below their net asset value. Now, this is most certainly, guys, not the first time that we've spoken about private equity in the modern climate, with, of course, private equity firms struggling greatly with the current situation of high interest rates and the other issues present within the US economy, Eurozone economy, and British economy, where, of course, most of these private equity firms do reside. And so we've spoken in length about the issues which are facing these private equity firms, a key one being, of course, that private equity firms at the moment haven't been able to kind of get rid of or sell their kind of private equity holdings, so their usual companies which they hold on to for a certain amount of time. It's quite a significant amount of time, but ultimately, at the end of that, they need to have a process of selling it, getting it off their books, and then rewarding their shareholders, their investors, or even those that have issued them debt for those transactions and those investments. And so that's what is very important, and what is also the current issue for these private equity firms that haven't been able to do that in this current climate with high interest rates. Added to that, private equity firms have also been struggling with the current situation of not being able to acquire new capital, and that's largely due to the fact that, once again, we have these higher interest rates within the economies like in the Eurozone, like in Britain, and like in the US, where, of course, these high interest rates are too costly for these private equity firms to start taking on debt for these important investments, which would usually be their strategy for acquiring companies and then selling them off maybe 4 years down the line. And so that's kind of the key issue which has most certainly been facing these private equity firms in regards to both gaining the kind of debt that they need to buy new companies, but also require the kind of situation with being able to find a market in which they're able to sell their kind of holdings. Because ultimately, as we've seen during this period of higher interest rates, ultimately there's been a drop in public offerings, IPOs, and other kind of forms of direct transactions in the process of selling one of these private equity holdings. And so as a result, these private equity firms have large holdings of their assets, and they're holding on to those assets for longer than they usually would, or basically should. And they have these investors, they have their stakeholders, which are basically demanding an exit from the business. They want to kind of cash back in on those initial investments into the firm, but these private equity firms aren't able to basically find the cash for those offers and for those exits from the private equity firm themselves, because they're not able to sell those companies in the usual manner. And so what this article kind of highlights here is that secondary markets, as we've spoken about before, are the key thing which is being used by these private equity firms in the modern climate to basically exit a certain holding and then reward their kind of shareholders. The issue is, as this article does, of course, highlight, is the fact that ultimately when these investors, when these private equity firms are selling their holdings in the secondaries markets, ultimately they're getting lower prices than they usually would, in the usual methods that they would use to sell these holdings. And so as a result, as I've just mentioned, 99% of big investors are selling their private equity holdings below their net asset value. So that is incredibly significant to kind of consider. And I think most certainly, as we've kind of alluded to before, certain investors are now questioning what is the value to them in regards to private equity. Is it even worth going down? And as a result, we've seen many of these larger investors and certain funds and that kind of thing move more so towards kind of fixed income and other kind of derivatives. So that's kind of been a key thing to note in regards to private equity and what we've previously spoken about. And of course, whilst there has been issues to do with finding kind of capital for investments, these private equity firms, ultimately private equity firms, just like as they've discovered the secondaries market for selling, they've also found other ways to kind of leverage debt and buy debt and exchange one investor's kind of investment for another investor's investment and that kind of thing, to basically get around these issues to do with raising cash and rewarding investors with their cash. So most certainly private equity firms have been trying to work around it, but as this article does highlight, there's still significant issues within the industry, and investors are struggling greatly with kind of selling their holdings at a fair value. So that is the key issue at the moment. Now, this marks the greatest number of such activity since the figure was started to be tracked back in 2017. And to make a comparison to kind of put these things into perspective, the figures for such an activity in 2022 was 95%, and in 2021 the figure was 73%. And now, of course, in the year that we are, the current figure is of course 99%. So we've kind of seen that dramatic rise over the past few years, where we started to see these higher interest rates of these firms, of these big investors, starting to sell their private equity holdings basically at a lower rate than what the kind of fair market value should be. So most certainly this is a very important article and a very important topic to note. Now, these investors have also been forced to sell their holdings in the secondary market, since the traditional avenues for exit in private equity has recently been subdued, and that's what we spoke about with IPOs and that kind of thing. A large reason for why pension funds have been the large culprits for selling under value is because many pension plans are forced to make payouts to their beneficiaries, and thus are forced into the secondary market in order to raise cash fast. And the public pension funds in the US have an average of 11% of their assets in private equity this year, with many also, as I read in this article and others, with many other firms also now reducing that stake. So in a key large pension firm in the US, I can't remember the name exactly, but we did also see the firm start to restructure their private equity holdings from 12% to 9% of their entire portfolio. Now, a key issue in private equity as well is that higher than usual interest rates has reduced the value of private equity portfolios, and thus investors have flocked to fixed income assets, with this being a key reason to why there is a significant secondary market discount. The size of such discounts in the secondaries market has shrunk, however, in the recent months, since the Fed is now focusing on the question of when to lower interest rates, and that's what we've been largely talking about recently. Yet in yesterday's market briefing, of course, I highlighted the fact that the Fed chair, Jerome Powell, has now kind of changed his rhetoric into something that's more hawkish, and now we're expecting only rate cuts to start really in the second half of this year, which is quite significant, of course, because we were expecting it very early on back last year and the start of this year. So very interesting times for private equity. Definitely keep your eyes on the topic, but we stayed on the topic for too long. Next article to talk about is to do with Google and AI, a very important topic, of course, that we cover extensively. We've covered Google around 3 times on this channel probably in its own article, but ultimately, Google is of course a leader within tech, but many are worried about the future of Google due to the emergence of AI and that kind of thing, with ChatGPT 4 of course kind of threatening the Google business model based on advertising. And so here we're kind of starting to see Google develop its own AI powered search model in order to kind of combat those risks and offer their own alternative. Now Google is now contemplating charging for premium features powered by new AI tech. This comes amid new AI Google features being developed, with this change setting itself up to be the biggest shape up of its search engine business, with this move looking to mark the first ever time that the company has put any of its core products behind a paywall. Now of course we've covered extensively the rise of AI. The likes of ChatGPT 4 have ultimately disrupted the tech market, and of course we've seen the likes of Nvidia over the past year and two basically rise to extreme highs based on this kind of AI revolution and their chip technologies as a result powering it. So ultimately, these large tech companies have of course tried to look for their own ways to kind of incorporate AI. Of course, we know that the likes of Microsoft have stakes, I believe, in ChatGPT 4, through certain methods, certain ways, and that kind of thing. And we also know Meta's developing their own team and that kind of thing. Google is the same. And here, of course, we're seeing Google try to kind of develop that AI model, but ultimately in the process, kind of putting at risk their key business model, which is that basically they've offered free services, that being their search engine, for quite some time now, of course, and I think many of us have become accustomed to using it, as I do on a daily basis. And ultimately, many customers have become used to just logging on to their computer, going onto Google, doing their daily tasks, and just dealing with the advertisements which Google kind of uses to basically earn their kind of revenue for their company. Ultimately, though, what we're seeing here is kind of Google changing their mind on the topic of, just offering free search engines and, then powering that through advertising. Instead, what we're seeing here is, offering premium subscriptions for customers which want to use AI powered search engine tools. And then as a result, kind of keeping as well those advertising tools for the free users. So this is, of course, a massive shake-up. And the question is, how will this affect Google? And of course, this will be very important when we do look at Google on the charts just after this article. Now, this all comes as the release of the likes of ChatGPT-4 put at risk Google's advertising business. Executives at Google have not yet decided on whether to launch it or not, but engineers are in fact developing the technology required, according to reports from the FT. It seems that Google's basic search engine would remain free and ads would continue to appear even for subscribers to the new service. Despite that, however, ultimately Google has always offered free consumer services, all powered and funded by the advertising that Google would sell. So very big change up for Google, and a very important topic to highlight. Of course, we'll come to Google once again on the charts. Just wait a second for that. But that's all to talk about on the articles. Next to talk about, of course, is the charts, where we start off on a very significant moment for the US 30, talking about US indices as a whole, as we will just move on to the S&P 500 in just a moment. But to begin with, we are talking about the Dow Jones, the US indice that we're kind of always covering, and that is largely because it is that kind of old traditional US index which has been kind of tracking the US economy and moves in very clean ways. So we like to always kind of follow this. And what's kind of been interesting about the US 30 is, of course, as the US equities market has rallied basically at incredible levels since last September of last year, ultimately, what we're seeing now, what we're seeing this week as we end off the week, is just an overwhelming amount of kind of bearish momentum entering the market, as the kind of shape and the kind of future for the Dow Jones is kind of changing in real time. Now, of course, in yesterday's market briefing, sorry about my nose, in yesterday's market briefing, we were, of course, highlighting Jerome Powell's rhetoric, which was changing now from that kind of dovish rhetoric that we were hearing back last October and kind of all the way through to the new year, to now the rhetoric that we're hearing from Jerome Powell, which is far more hawkish, obviously following a great deal of strong economic data from the US, a great deal of strong inflation data from the US. Jerome Powell's rhetoric, along with most other Fed officials, has changed to one which is far more hawkish, with the Fed chair Jerome Powell basically talking about rates staying higher for longer, most likely, kind of putting off the idea of interest rate cuts, talking about waiting until inflation data properly shows that inflation is moving to that 2% target. And so I think as a result, as we're now seeing in yesterday's market price action, prices reacting to that in a very bearish manner, of course, with price selling off quite significantly, as we can see this drop off to levels not seen, of course, since the start of March. So very significant moves, and with the amount of time that it took for price to move up to that level, seemingly we could most certainly reclaim all those gains that we were kind of seeing over this period with a very significant retracement. Now, this is largely to be expected, as I have spoken about many times. US equities at the moment are quite overvalued if we're just looking at it on a basic, has there been any retracements recently? How long has there been since a significant retracement? We've really not seen that. And it seems like now that we're hearing this more hawkish rhetoric from the Fed and, certain messages around the US economy and that kind of thing, the markets are now responding, and possibly, of course, a retracement may follow after price, coming and breaking below this key liquidity level, and then on Thursday and on Wednesday basically making its way up to that level and reacting to that in a very bearish manner. And now we're seeing this kind of move to the downside. So definitely keep your eyes on the US 30, as there's certainly now a great deal of kind of bearish potential as we do end off the week and then start next week. So definitely keep your eyes on the US 30, as we are also getting the US NFP figure, which of course will be massively impacting the US equity index today. So definitely keep your eyes on all of that. Next to talk about, though, still on top of US equities, is the S&P 500, which I'm going to have to cover quickly. But just like on the US 30, we're seeing a sell-off, just not as significant as we did see on the US 30. Now, I want to bring up the daily on the S&P 500 just because I wanted to contextualize the lack of retracements that we have seen since the beginning of the kind of rally on the US 500, the S&P 500, beginning last year in October, after we did hear that change in rhetoric from the Fed. And since then we've seen just price rally to the upside, and if you can see here, we've really not seen any kind of retracements take place. I mean, this was a very small retracement, if you can even call it that. If we just draw out a fib on that area, price didn't even retrace down to that 61.80, very short retracement. And from that point, even, we haven't seen a retracement in a long time. So most certainly we could definitely be facing now a retracement after this long period of price becoming overvalued. As if we just look on the RSI index as well, of course, we can then start to see this bearish divergence, which has certainly formed all the way since, mid-December last year. So certainly price is in a very interesting position right now, and price is also reclaiming a lot of those gains that we did see throughout March and that kind of thing. So definitely keep your eyes on the S&P 500. That's all to talk about in the US equity indexes, though. Next to talk about is the dollar, which is in a very interesting position after reacting to the 61.80 Fibonacci retracement level yesterday. The question is, of course, whether, based on the US NFP figure that we do receive today, whether price will then move to the upside or downside, because it does seem like the balance of trade figure from the US that we did receive yesterday did push the dollar to the upside a bit. The figure wasn't that significant, though, so that's why we're not seeing an overwhelming move to the upside, despite the data kind of giving us a very positive dollar view. So ultimately, price is on the move to the upside after coming into contact with that 61.80. But yet, once again, we don't have that kind of full bullish confirmation of a significant move to the upside just yet. And that US NFP figure today will be very interesting to see, and that will definitely see price interacting with these key liquidity zones. So keep your eyes on all of that most definitely. Next to talk about though is Euro USD, so still on top of the dollar, which did kind of peak above this area of liquidity that we noted yesterday and has now broken above this kind of entire range. The question once again for the US NFP, the US Euro USD, is ultimately what will that US NFP figure be and how will that then impact Euro USD. So definitely keep your eyes on the euro. Next to talk about though is pound yen. Pound yen's making some very significant moves. Obviously, starting off this week, I did highlight how price had just interacted with the 61.80 ending off last week, and the opportunity was of course that then the pound was to then start moving to the upside after coming into contact with that that bullish area. Price did do that throughout this week, but as you can see in yesterday's market action, price did then react to this other 61.80 on the other kind of side of the market, and so now price is on the move back again to the downside. That said, price is possibly interacting with this liquidity level right now, so we can't yet confirm a full bearish move in progress, but definitely keep your eyes on pound yen as price is once again reacting to these liquidity zones and Fibonacci retracement levels in quite significant manners. That's all to talk about on pound yen. Next to talk about is Bitcoin. Bitcoin has just been moving incredibly volatile recently, and of course price did move in a bullish manner away from that 61.80 that we did highlight on Wednesday this week, and since then price has moved to the upside. That said, price also did come into contact yesterday with this liquidity zone, which of course was marked previously as a kind of support level, but is now seemingly acting as a resistance level. The question is of course whether price can break above that, or will price now continue to the downside. So keep your eyes on Bitcoin. Next to talk about though is gold, which is actually stalling at its highs at the moment. Of course, we've been talking about gold a lot recently. If you want to see more on gold, look at yesterday's market briefing. We spoke a lot about gold then. Next to talk about though is oil, which is just continuing to push higher and is now fully breached above that $90 a barrel level and is now in the $91 a barrel territory and is very close to that $92 a barrel territory. So very significant oil moves recently, and price is now within those kind of October levels, which is so significant, of course. That's all to talk about in the charts though. Lastly to talk about, of course, is the economic calendar, where we're getting a great deal of data today, so listen out for all of this. Firstly, we're getting the Japanese household spending figure, followed by the Aussie balance of trade figure, followed by that we're getting the French industrial production figure, and then the Swiss consumer confidence figure, followed by that the British construction figure, and then the Eurozone retail sales figure, so a very important Eurozone figure there. And then more importantly, across the pond, we're getting two very important pieces of data. Firstly, the Canadian unemployment rate figure, as well as the US NFP figure. That will be the key one affecting all markets, including, of course, and most importantly, the US markets. And lastly, we'll be receiving a great deal of numerous Fed officials, which will be speaking today as well. That's all to talk about on the economic calendar, though. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading day. But that's all from us at Wildwood Capital. Have a great one. See you later. Bye.